As it happens, the government leader in the Senate, Chris Evans, has written to the Senate President today, seeking a reference to the Senate Privileges Committee to investigate whether there has been any collusion by Messrs Turnbull and Abetz with the Treasury official Godwin Gretsch to predetermine the outcome of a Senate hearing on the Auscar scheme. The mining giant, Rio Tinto, has again today reiterated a denial that its senior Australian representative in Shanghai, Stern Hu, was guilty of commercial espionage, which China insists has cost its steel mills more than $120 billion in overpayments to Australian mining companies over 6 years. More than a month after Stern Hu was arrested by state security officials, he has still not been charged. Prior to his arrest, he was leading Rio Tinto's delicate discussions with Chinese steel mills to set prices for the 100 million tonnes of iron ore that the miner was hoping to sell to China this year alone. Despite fears that the diplomatic row would spill over into a booming trade relationship, China's appetite for Australian resources appears undiminished. Business editor Greg Hoy reports.
It is an $18 billion minefield. Dividing on one side the world's biggest iron ore exporter, Australia, on the other by far its biggest customer, China, the Dragon Nation, devouring almost 2/3 of ore exports, or 183 million tonnes last year, to feed its great need for cold hard steel, vital to the massive modernisation of the Middle Kingdom.
Urbanisation is unstoppable. Every single year, we're expecting some 15 million people moving from the countryside to become urban residents. China's demand for commodities is extremely strong.
But the rift between buyer and supplier began last year when the biggest Australian producer and lead price negotiator with individual Chinese steel mills, Rio Tinto, struck a dramatic 85% hike in benchmark prices for iron ore. Ever since, pricing has been a volatile subject for all Australian producers.
There's no question the Chinese are certainly a bit grumpy. I think they're grumpy about the very strong price increase that prevailed last year, and it's going to take a little bit of time before the previous bridges can be rebuilt in terms of the relationship between the suppliers and the consumers.
The wrath of a dragon, emboldened this year by global financial doldrums, falling Chinese exports and rising iron ore stockpiles at its ports, China's state-controlled Iron and Steel Association took over tense talks on iron ore prices from steel mills, demanding a 45% cut from Rio Tinto and others. Rio offered just 33. The deadline for settlement passed anxiously. 4 days later, Rio Tinto's head negotiator in Shanghai, Stern Hu, and 3 of his team were arrested and accused of stealing state secrets, placing enormous pressure on Rio Tinto. But has it really helped the Chinese negotiating position on benchmark iron ore prices?
I don't think that there's been any real material impact. I think that we need to look beyond these arrests and look at the bigger picture. The arrest is only a small blip in China's, I guess, demand, because it's just going to keep storming on.
In recent weeks, the iron ore price has certainly started to move up very quickly, and I think that's evident in some of the other commodities as well. Certainly we're seeing stronger demand, a replenishment of some of the stockpiles, and a much more positive outlook by the steel industry in China in general.
We've seen steel prices reaching 2009 highs as of this week. So as steel prices recover, as steel companies in China become more profitable, they're more capable to absorb higher iron ore costs.
The market's become very buoyant again in regard to the premium grades, from a level of about $65 to $68. There's reports on the market today that there are some sales being concluded at $100 or close to $100. So it's been quite a dramatic turnaround in a very short period of time.
Dwarfing the Stern-Hu issue and the problem for the Chinese Iron and Steel Association is the very ground on which it's dug such an entrenched position on Australia's iron ore prices is shifting fast. For all the insecurity about the impact on China of the global financial crisis and fear for economies like Australia's so dependent on revenue from resource exports, Beijing's whopping 4 trillion yuan stimulatory spending package appears to have worked wonders, disproving doubts that China could maintain its great goal of 8% economic growth per annum as required to keep its huge modernisation program on track.
So the 8% GDP target can be achieved despite the weakness in exports. You know, the Chinese government's stimulus program has been extremely effective. The Chinese economy already staged a V-shaped recovery. I think this is a reason why China has been leading the global economy out of the recession.
JP Morgan's chairman of China Equities and Commodities, Jing Ulrich, last year rated by Forbes magazine as one of the world's 100 most powerful women, influencing the investment of trillions of dollars globally into enterprises in China, believes there is no turning back for the Middle Kingdom's economy.
I actually think the momentum is so strong in the underlying economy that in the second half and into 2010, the Chinese GDP will grow very strongly, continuously. And this is because internal consumption has been very strong. You are seeing very strong car sales. In June alone, car sales actually rebounded by some 48%. And also, if you look at home appliance sales, they're surging as well. So in the face of a very weak global economy, the Chinese internal consumption has been pretty much offsetting the weakness in exports.
The implications for Australia are profound. This year, exports to China generally grew 17.5% in the first 5 months, as exports to other countries dropped 13.5%. Where once the lucky country rode comfortably on the sheep's back, now it clings to the tail of a rising dragon, which poses both great opportunity and inherent risks.
China's emergence also presents challenges. If we are more integrated into China's expansion, we will similarly be more exposed to the consequences of whatever might go wrong in that country. So our understanding of how the Chinese economy works and of what risks might be accumulating there will need continual work.
For now, the forecasts are for fair weather trading.
What we're looking at is a 3-stage recovery in China, in which the third stage is now just beginning. The Chinese public would then start to unlock their own $4 trillion savings in their bank accounts. And we're not even including the $4 trillion that's sitting in corporate bank accounts at this moment. So what we're seeing is that we're in the third stage of a prolonged recovery for China. And we're certainly seeing the growth figures, the PMI figures that came out at the end of last week also showed more recovery.
It all augurs very well for Australian resources. Veiled threats China would switch its iron ore orders to more distant and thus more expensive Brazilian suppliers have proved hollow. Price negotiations have reached a farcical hiatus. China continues to buy record levels of Australian iron ore, for which it is either accepting the price it tried so vehemently to reject, or it's paying an even higher premium on the spot market. The worry is this may leave China holding just one card with which to save face, which of course is the continued incarceration of Rio Tinto's Stern-Hu.
Greg Hoy with that report, and that's the program for tonight.